Bonds are sometimes referred to as fixed income investments. Now, while their income may be fixed, in today's video we are going to talk about the price of bonds, which is definitely not fixed. We're going to look at a chart that I've used in the past for the stock market to show the volatility, and then we're going to compare that same chart but use bonds instead, so you can get an idea of how much to expect your bonds to potentially go down, or the price of your bonds to go down in your portfolio. Okay, so let's get started with stock market volatility first for some context. This chart here, we've gone through this before, but essentially what this looks at is these gray bars, some are positive, some are negative, tells you the ending rate of return for the stock market that year. Then you have these red dots that show up underneath. These red dots represent what's called intra-year volatility. So how far does the stock market drop from its peak at any given time during the year? And as you can see, essentially every year you have a drop from its highest value, which makes sense. And so you've got the stock market, you've got some ups, you've got some downs. You've averaged about 10% rate of return during this time period. So we have some volatility, but we're getting a return. Well, how does this work in bonds? Many times we buy our fixed income, or we buy our bonds, let's call it a 5% bond. We expect to get 5%, and then we expect to get our money back at the end of the term if the company doesn't go bankrupt, or if it's a government bond, as long as the government is still paying its obligations. But what happens between the day that we buy it and the day that it matures is the value of those interest payments goes up and down in the markets. People are willing to pay either more or less for that bond. Well, how much more and potentially how much less? Let's look at this chart here. So this looks very similar, except now the numbers change a little bit. This is looking at the aggregate bond index. So let's call this a whole bunch of high quality bonds. How much do they move up and down? And as you can see, you've got these black bars. They're much lower numbers, right? So you see a lot of 7s and some 5s and some that are higher. And then you see these red dots again. And just like in the stock market, the red dots show up every year. And so what does that mean? It means bond values drop every single year from their peak at some point. And if we think about the magnitude comparing to stocks, there were some pretty dramatic drops, 20, 30, even 40%. Bonds don't have that level or severity of drops. However, they are just as common. And so there are a couple of time periods that I want to point out. The first one being going all the way back, where we see kind of around the 80s, the early 80s, right? Late 70s, early 80s, you see these drops, 7%, 9%, etc. And then 22 and 23, where you see down 17 and down 7%. These are safe bonds. And so keep in mind, if you were to be buying lower quality or junk bonds, trying to get a higher yield, you might have had an even different or an even bumpier experience. And so why do the bonds go down this much during these time periods? Well, when you have high quality bonds, the reason a value may go down is it's inversely correlated, or in other words, said it moves the opposite direction of interest rates. So if interest rates go up dramatically, the value of those bonds goes down because people are willing to pay less for those payments because they can go out and get a new bond that pays them higher rates because rates are higher. So that makes sense. And so keeping in mind, it's not as simple as just putting your money in a bond, buying a bond, accepting a fixed payment for a fixed period of time, and then getting your money back. As long as the company keeps paying, that will be the case. But during the time period between when you buy it and when you sell it, the value is going to fluctuate. The dollars on your statement is going to move around, just like stocks. And so when you're building your investment policy, make sure that you understand the volatility of both stocks and bonds, because they have different risks. One might be the ups and downs of the stock market just based on what people are willing to pay, what they think these companies are going to be worth in the future, versus in the bond market, it's a different kind of risk. And many times when you're buying high quality bonds, it's interest rate risk. So do you feel comfortable with where interest rates are and where they may be heading in the future? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.